All right. Good afternoon, all you magnificent melon heads out there. Happy Friday, everybody. It is my favorite time of the week, my Friday afternoon live stream, where I get to talk to all you fine people about all things going on in the world of finance. And there's no shortage of things going on in the world of finance today. Good news, everybody. Our banks are strong again. The crisis is over. Again. How many times has this crisis been over now? 4 or 5 times? Thank God this crisis keeps ending. Whew. Be a shame if this crisis were to continue. Regional bank stocks rocketing higher today. All it took was the White House starting the rumor that they were going to ban short selling of bank stocks, and then the regulators threatening to investigate short sellers of bank stocks. And go figure, when that happens, people don't short bank stocks, and the bank stocks go up. Are the balance sheets of these banks any healthier today? No, of course they're not. Probably worse than they were yesterday. But bank stocks are rocketing higher. Also, we're all still just swooning from that glorious jobs report, which was an absolute joke. I won't rehash the whole thing, but it was just total political economic theater. All of these job gains are erased if you look at the revisions that they just quietly released to the February and the March numbers. I mean, this octogenarian clown that occupies 1600 Pennsylvania Avenue is on Twitter, or his handlers are on Twitter, because at this point he's probably taking a nap or drinking his prune juice, is bragging about the 253,000 jobs added in the economy. Come on, man. Telling us how good it is. No mentions, hey, we revised March's numbers down by 98,000, and we revised February's numbers down by 78,000. So if you subtract that 176,000 revisions down from the 253,000 jobs we supposedly added, all of a sudden we go from this massive beat to a miss by over 100,000 jobs. U.S. economy only actually added 77,000 jobs once you take away those revisions. No mention of that in the tweets. No mention of that in the press conferences. Certainly no mention of that in the CNBC headlines. But you know what? It's all right. The crisis is over. But look, folks, whether this crisis is over or not, I want to emphasize this crisis wasn't even the crisis. It's just the crisis before the crisis. You see, the actual crisis comes later. This was just unrealized losses caused by the Fed's interest rate hikes. All right. When the Fed raises interest rates, the value of bonds go down. And what do banks do with your money? They either make loans or they buy bonds. That's how banks make money. The interest they make on their loans or bonds is more than the interest they pay you. Well, when the Fed raised interest rates, they lowered the value of those bonds and those loans. Mortgages, loans on cars, they function essentially like a mortgage, right? When the interest rate goes up, the value of them goes down. So when the Fed raised rates by over 500 basis points, they were wiping out the value on the bank's balance sheets that they used as collateral against your loan to them. Remember, if you have money in the bank, you are a creditor of that bank. You have loaned money to that bank. And the bank's collateral is the bonds and the loans on their balance sheet that are now worth less. That's what caused Silicon Valley Bank to fail, and Signature Bank and First Republic Bank. It wasn't like 2008, people not paying their bills. That comes later. That hasn't even started yet. We're going to talk about a little bit of that today. And also today, we have a special treat with us because my man Mish the Mod, who is with us in spirit, he is on the road today. So we have got my buddy Eric from Above My Pay Grade is in the house. Eric, how you doing today?
I'm great, brother. Thanks for having me on. I got to say,
anytime.
Your Joe Biden is almost as good as your Janet Yellen.
I think my yelling is a little stronger. Our banks are resilient. Thank you.
Yeah, Jack and I were talking. I'm on the road too, but I've been traveling a lot this year and last year. And we were talking about how bad. Like, I'm kind of insulated. I live in the suburbs. A lot of us either live in the country or the suburbs. But if you make it out, I'm close to Atlantic City right now. America's not doing so hot. Like in the impoverished areas and in the cities. If you've been, I say all the time on my channel, get out of the cities because the cities are going to fall. But if you make it into them, it's bad and very, very sad.
Yeah, you know, I live in rural Pennsylvania, not in the middle of nowhere. I live on the edge of nowhere. I can still get to things and stuff if I need to. But I love the solitude, the quiet of it out here. The few neighbors I have are wonderful people, so I don't really see what you're describing very often. I did see it a few times with some of my travels that I did last year, because when you travel, you can't help but go through cities. And what I saw was pretty grim. I mean, the first time you see a pile of human excrement on the sidewalk, it is an eye-opening and nose-closing experience.
Hmm.
And you're like, wow, that's real. That really happens. My God,
Yep.
that's not a dog. That was a person.
Yep.
You were telling me about an Instagram. Can you tell me politely about this Instagram account you were mentioning?
Yeah. Is it chocolate or is it excrement? There's one in Denver and there's one in Portland, one of the cities I've traveled to a couple times this last year. But yeah, the Instagram guy goes around and finds stuff on the street and then asks his followers, is it chocolate or is it excrement? But he doesn't use that word, of course.
And I mean, folks, we've got any number of causes in the United States. You've got a mental health crisis, obviously, drug abuse. We've got a lot of homeless veterans. Uh, but we've also got people who work jobs who make what a few years ago would have been considered a decent living. And they live in cars, they live in tents, because the helicopter money, the deluge of stimulus, and the Federal Reserve's actions and decades of low interest rate policies have priced them out of living with any shred of human dignity. It's not right. And, the one silver lining to all these things that I'm watching, these bank failures and what could come behind the bank failures, because we haven't even seen the crisis. The one silver lining I keep saying to myself, because it will be very painful for a lot of people if this deflationary bust happens, but the silver lining is all these poor people who are living in tents right now might actually have a chance to get a roof over their head. If housing prices are cut in half, if the housing market absolutely crashes, if banks go under, maybe these people have a chance to get actually into a structure. Maybe we can reset. I'm not going to call it the Great Reset. I would refer to the deflationary bust as the Magnificent Mulligan. That's what I'd like to call it. Not the WEF's Great Reset idea. No, we get rid of the froth. We get rid of the asset bubbles. We let the prices reset to where the market wants them to be. That includes labor, by the way. And then maybe people have a chance at a decent living off of one salary, and maybe one parent can actually raise the kids. My God, what a concept! So that's the end of my rant. Let's take a look through the indexes and through the markets today, shall we, Eric? Oh, that's the wrong button there. Let's shrink my melon a little more than that. There he is. All right, the S&P 500 is up an entire 80 points right now, almost 2% on the day. Yikes, 4,142. Dow is up 571. Number go up. Why not? I mean, we're what? 4 days removed from the second largest bank failure in American history. Of course, the Dow is up 571 points, or 1.72%, at 33,698. And the NASDAQ is up 2.34%, 280 points, 12,246 for the NASDAQ. Kathy Wood is smiling over in Disruptorville, wherever she lives, that head in the clouds area she's from. And the U.S. dollar, the DXY, is at 101.23, up 0.17%. I don't have this chart queued up, but I want to bring this one up real quick. Give me 1 second here. This trading view chart, I've looked at this a couple of times, and my friend Brian Zarb from thetechnicalchartist.com posted something similar on Twitter today, talking about the dollar and how the DXY is kind of, I forget what he said, on the brink, walking the tightrope. First of all, I'm going to delete my arrow because that's my opinion, the arrow. All right, so I'm going to get that arrow out of there. But this is the DXY going back to the start of last year. Pretty clear head and shoulders here. All right, now it looks like it's starting to break down. But in my opinion, what it boils down to, where the DXY goes from here, is essentially a Boolean decision by the Federal Reserve, or not even the Federal Reserve, the FDIC. Because regardless of what the Federal Reserve wants to do, the FDIC can force their hand. If the FDIC comes out and says, to stop this crisis, we're going to guarantee all deposits at all banks, which is what, $17.2 trillion. Come on. How are they going to guarantee $7.2 trillion? As I mentioned to Brian on Twitter, the only way to do that is to slap a Buzz Lightyear sticker on your money printer to infinity and beyond. The Fed's printing press is the only way the federal government could ever possibly guarantee all deposits. And that's what they're talking about doing. Now, if that happens, this chart is going to break lower in a big way because that will show that the dollar is done, right? An implicit guarantee of all deposits in all banks is basically the government saying our word is trash, which in my opinion is already trash. But the rest of the public, John Q. public, for some reason still believes the government about anything. Now, the flip side is if they don't do that, if they don't implicitly guarantee all deposits at all banks, you're going to have more bank failures. It's simple math. They've raised rates so fast, their assets are worth less. It's just a matter of time before these banks are insolvent. We're going to talk about a couple other triggers today that might force this in the future. If that's the case, then you're looking at a global shortage of dollars as debt defaults, and this chart is going to rocket higher. So those are their options right now. I still don't know which way it's going to break. And that's why I'm not doing much trading these last few weeks and months. I'm really not, because I don't know which way this is going to break. I'm still sitting largely in cash. Another thing I want to point out today, check this one out. Eric and I were just talking about this before we started. The U.S. 1-month Treasury up 91 basis points today. Guys, that's not supposed to happen. Bonds are not supposed to work like that. Well, let me get my chart. Here we go. It's at 5.46%, up 91 basis points. It reached a high of 5.73%. And this all started yesterday with the 4-week Treasury auction that happened last night. And this is telling, in my interpretation of this data, is that the debt ceiling, the X date, is now closer than 1 month. And so nobody, the acronym or the metaphor I used on the live stream this morning was nobody wants to pick up 1 month pennies in front of the debt ceiling steamroller right now. That's my only explanation for such a, my God, look at the size of that move. A 20% move in the 1 month Treasury yield in one day.
Now, do you think, you mentioned the debt ceiling. My understanding is they hit that debt ceiling. They just have to choose what bills they pay. Am I correct?
Yes. Well, they've already hit the debt ceiling, right? So that they can't borrow anymore. That's what the debt ceiling is. They can't borrow any. Yep. So they can, if they pay back $1 million worth of bonds, they can only borrow another $1 million worth of bonds. Right. But in a rising interest rate environment, that means the interest expense is going up. So they borrow money to pay interest right now. So when they run out of money, which is the Treasury general account, Uncle Sam's checking account, when that runs dry, it's not a matter of deciding what bills to pay. It's not a matter of not borrowing anymore. They default. The very next bond auction, they would default because they won't be able to borrow enough to pay back what's maturing because they'd be rolling over debt into a higher interest rate environment. And right now they're down to, I believe it was $188 billion in the Treasury general account today. And the last 2 days in a row, they burned through about $25 billion in cash. The day before that, $78 billion in cash. So, the bond market sees this. They see the rate that balance is dropping, and they're saying that, they told us June 1st. I don't think it's going to be June 1st. I think they're going to run out of money before June 1st.
And so if politically they do their thing, which is jawboning on both sides, they could run out of money, as you say, before June 1st. And then not pass this debt ceiling increase until let's say they run out of money May 15th, and they're like, oh crap, we just ran out. They have to pass that debt ceiling overnight, and they're playing a game of chicken right now, as we all know. And the political process takes a while. So what if that political process has a 1 week delay?
Yeah, it's got a 1 week delay, and also, keep in mind, I've been using the phrase a political accident. There's the likelihood of a political accident. And when the Wall Street bailout in 2008 was passed, they actually failed the first time around in the vote. They finally secured all the votes. The parties came together. They reached their compromise. John McCain suspended his campaign to help with the negotiations, and then he's like outside in the hallway banging on the door, and the Democrats were like, no, we're not going to help your campaign by making it look like you contributed to this discussion, so stay outside, John. Well, anyway, they finally got done with all that stupid theater, and they had a bill, and they had the votes, and right before the vote, Nancy Pelosi got up on the House floor and made a speech that blamed the whole thing on George Bush, which, whether you believe that or not, it's what she said. And she referred to the bill something as like the George Bush rescue plan or something, like basically slapped the whole thing on the other side, said it was your fault and that's why we have to do this. And so she immediately placed every Republican on the House floor in the position of endorsing her speech by voting for that bill, which would have basically laid the full blame for the crisis on George Bush, who wasn't innocent in the whole deal, but he wasn't the sole reason for the crisis. And so she lost all the Republican support for the bill when she made that speech, and it failed. That was a major political blunder by Nancy Pelosi, and it cost the country. The Dow dropped like 1,000 points that day or the following day off of that nonsense in Washington. And so they had to, again, come back together, start negotiating all over, more political theater. Eventually they got it done. But that was a political accident that was very expensive for a lot of people. And the circus in Washington has gotten just more embarrassing since that day, significantly more embarrassing. So, we could have something like that play out again. So I mean, and there's no shortage of buffoons on either side of the aisle who would stand up and make a stupid speech like that would make it impossible for the other side to vote for the bill, and then it fails.
So let me ask you, if there's a 1 week delay, let's say we run out of money in the TGA and it takes them a week to get their act together and vote to raise the debt ceiling. In that week's time frame, is there any defaults happening, or does it depend on when the bond auctions are?
Now we're getting into the unprecedentedness of it. How do the mechanics of that play out? I couldn't tell you. My guess is the first bond auction after that date, right? I mean, as it is, people won't get paychecks, and government offices will shut down, all that stuff. But the actual default comes after the first bond auction when the government doesn't have enough money to pay the maturity on the maturing bonds. And that's when we see interest rates spike and we see the Dixie spike, if that were to play out that way. By the way, I got to say thank you so much to Mr. Jake's Custom Parts for your very generous, look at that, it's a red one or a purple one. Thank you, Jake. I appreciate that very much. He says, ice cream for Jack's awesome parents and lovely wife, but an apple for Jack. All right. I'll take my apple while everybody else gets ice cream, and I'll pout in the corner and eat my apple. Thank you, Jake. I'm sure Gigi and the girls and the parents will enjoy their ice cream. All right, Dad, Mom, love you guys. I'm sure you guys are watching. We're getting ice cream the next time we see you. Thanks a lot, Jake. I really appreciate the super chat, sir, and the support of the channel. You, sir, are a gentleman and a scholar. Let me make sure we're all caught up on those. There's a lot of people in the chat today, and we are. All right, let's move on because we haven't talked about commodities yet. Commodities, gold down $30 today. All things considered, that could be a lot worse at 2025. Gold just off its recent highs. Silver at 25.93, down 30 cents. Again, all things considered, silver could be a lot worse today, just under $26. Crude oil up big today, $2.88 at 71.44, and natural gas at $2.10, up just under a penny. So not a lot of movement in the commodity space. Now, I saw this chart on Twitter today, and I had to mention this. We're back on the jobs numbers now. And this, in my opinion, what we're seeing here, streaks of better than expected non-farm payroll reports from 2000 to 2023. We now have 13 consecutive months where the non-farm payrolls report, the jobs number, comes in higher than forecast. 13 months in a row. Now, look at this chart, folks. Do you think the jobs market is just that much stronger right now? Keep in mind all the headlines about the 355,000 layoffs in big tech alone year to date. Do you think the jobs market is that hot? Or do you think political buffoonery has infected our economic data and we can no longer draw accurate conclusions from that data? I know which one I'd pick. Things used to be sacred. There used to be things where we kept politics out of it in order to preserve the sanctity of whatever it was, like science, right? Go figure. Science is math. Science is observations. It is the testing of hypotheses through repetition to arrive at a conclusion. When did science turn into this stupid, dogmatic, opinionated nonsense? And now it's into the economic data too. And look, businesses and government organizations and banks and everybody looks to these numbers in order to make forecasts for orders in order to plan their economic calendars. And you can't do that if the numbers is nothing more than political propaganda. Case in point, we had the big blowout numbers today. Oh, but yeah, last month, 2 months in a row. The last 2 months, we had to revise those numbers down by 176,000 jobs. Well, those 2 months that we just revised lower by 176,000, they're included in these 13 months of better than expected payrolls report. How about instead of lying about how many jobs were created to make your stupid administration look better, and then quietly revising it 2 or 3 months later to no fanfare, how about you just preserve the integrity of the economic data so people can make better decisions? And just throw them out there. You do what you want with them.
This strikes me as like the ratings agencies in 06, 07.
Perfect.
It's
Absolutely.
people are making economic calculations off of faulty data, including your Federal Reserve, although they probably know this. Yeah. We've seen a lot of charts that are like the 1 month treasury. They're going up and to the right, all these unprecedented up and to the right and down and to the right charts. And all of a sudden, they keep saying, everyone calm down, everything's fine. And we know it's not.
You know, it reminds me of, did you see the Chernobyl movie that HBO did?
Yeah.
2 years ago?
Yeah.
It's actually, coming from the nuclear space, I was cringing at the thought of HBO making a movie about Chernobyl. I thought it was going to be a bunch of anti-nuclear nonsense. It was actually pretty close to perfect. It was pretty close to the way they portrayed the technology, and there was some stuff that was off, but it was really good. And the one scene when they bought the German robot in, they had this German robot that was supposed to pick up the pieces of graphite and the pieces of the core on the roof of the reactor building and just throw them back into the core. And, they had tested it and they said, yeah, this robot is protected to work in a radiological environment. And it's rated, it can function in this environment. And they spent all the money and they brought all the resources to helicopter lift in this German robot to the roof of the Chernobyl reactor building. And they turned the thing on and it died in 10 seconds. Because when the Germans asked to see if their robot could function in that environment, the Soviets gave them the propaganda numbers about how radioactive the area was instead of giving them what the actual radiological conditions were on that roof. And the robot failed as soon as they turned it on. Again, the data, if you don't have accurate, good data, you cannot make accurate, good decisions on it. And of course, a very Soviet thing to do was they just decided to send people up on the roof with shovels. And that's how they take care of it. The robots die in 10 seconds, but we'll send people up there.
Yeah, and another parallel is in that show, they had some people that knew it was going to melt down, but they didn't want to say anything because they didn't want to speak against the regime. And you're seeing that more and more in America, yes, where people, if you're part of the administration, you don't want to say anything counter to the narrative. So it's all about selling the narrative. But the truth of the matter is gravity exists. So you can pretend all you want, but
yeah. The graphite tips of those control rods, they had warned in some of the studies before they built the RBMK reactors. They said under certain conditions, the graphite tips of these control rods could actually increase reactivity for a split second during a reactor scram. And of course, they just shrugged it off, ignored it. Nobody was allowed to speak up. Nobody was allowed to question it. And then, I could talk about Chernobyl for weeks. We're not going to get too much into that. But you're right. The inability to question authority played a major role in Chernobyl. Abso-freaking-lutely. Great job. All right. Let's move on from here, guys, because I got another ridiculous chart here while we're talking about how safe our banks are. Look at this. Look at this chart. Now, this is bank failures in the United States. This is a timeline. All right. So, the x-axis on this chart, that's going all the way. You can see the GFC there with all this junk here, right? There's Washington Mutual right here. Washington Mutual was the biggest bank failure in U.S. history. And then look at all these little banks that all died in 2008 and got gobbled up. And I can't help but look over here and just think, do you want to build a snowman? Tell me, I have daughters. I've seen Frozen more times than any man should ever have to sit through Frozen. I've heard those songs more time than any man should ever have to hear them. But that's all I think. Look at those three bank failures, second, third, and fourth largest bank failures in U.S. history, stacked one on top of each other, like Frosty the freaking Snowman. Tell me again how strong our banks are. And it's just the early innings of this crisis. It's just getting started. By the way, I'm told the combined assets of these three banks is now bigger than the GFC. I haven't scrutinized those numbers myself, but I've heard that repeated a couple of times. That Signature Bank, Silicon Valley, and now First Republic combined more than all of these little banks. So yeah, tell me again how good thing that crisis is over again. Tell me again how safe we are. And all they had to do to end the crisis. Here we go. This one today. White House says it's monitoring short selling pressure on bank stocks. White House Press Secretary Karine Jean-Pierre on Thursday indicated that the Biden administration is paying attention to the banking sector stocks. Well, that's good. I'm sure Biden's watching those tickers very closely. So pardon the image of Biden watching the stocks. God. When she was asked if the administration was considering imposing a stop on short selling of bank stocks like there was during the 2008 financial crisis, the administration is going to closely monitor the market developments, including the short selling pressure on healthy banks. Healthy banks don't fail, guys. All right. If these banks were healthy, then shorting their stocks wouldn't do this. All right. Now shorting stocks can contribute to the bank failures because it makes depositors fearful. If you see the stock of your bank dropping by 50%, what do you think you're going to do? You're probably going to pull your money out of that bank, right? That's what the wealthy are doing. But if these banks were really as healthy and as strong as they're saying, those banks would be able to meet those withdrawals. They would have no problem selling assets to raise the cash to meet those withdrawals. So these are not perfectly healthy banks because they can't sell those assets to raise the cash to meet those withdrawals because these banks are insolvent. It's a big detail. She said during the press conference, adding that reporters should refer to the Securities and Exchange Commission for information on any possible actions. Which leads us to our next headline. Exclusive U.S. officials are assessing possible manipulation on bank shares. So not only is the White House starting the rumor that they're going to ban short selling, but they're also threatening anybody who's shorting a bank with regulatory scrutiny, regulatory retaliation.
This is just making price discovery illegal, essentially.
Yes.
Like they did in '08. It's do you put any credence to the fact that they might come out with a with withdrawal regulations?
Yes, I do.
Locking your money in the bank.
I saw two people say it. Rafi Farber did a video over at Acadia Economics talking about how someone at the IMF, somebody high up at the IMF, was talking about how the speed at which people were able to withdraw their money from Silicon Valley Bank was going to require. She caught herself and she said something like increased regulatory. What was the word she used? Like introspection or review. Like, oh, we'll have to look at that through a regulatory lens. In other words, oh, there was a stampede for the exit, so our solution is to lock everybody in the theater, lock everybody in the chairs. And Jerome Powell said something because he was asked during his press conference on Wednesday, towards the end of the press conference, somebody asked him, are you reviewing anything you could do differently after the bank runs? And the first thing he mentioned was how surprised he was by the speed with which people were pulling their money out of these banks. So the suggestion there is that one thing the Fed might do differently would be to slow people down. And, there's two analogies here. There's the people being locked below decks on the Titanic while the rich people are given the lifeboats. I used that one in a video the other day. Some muckety muck at the FDIC really didn't like that. He was tearing into me on Twitter. It was funny. Keep up the good work, FDIC. You guys are doing awesome over there. And the other one was the Chicago fire, the Chicago theater fire. I don't know if you guys are familiar with the Iroquois Theater. It was in like 1903. It was one of the worst fire disasters in American history. I had to study this when I was going through my firefighter training. 602 people died in this theater. And, it was this great big theater. They violated all kinds of city ordinances when they built the theater. It's alleged that certain people were bribed. Nobody was ever prosecuted, but it was alleged that certain people were bribed. A fire broke out because of a faulty light during the theater performance. A curtain caught fire, and the curtain the whole theater went up. And people were stampeding, people were suffocating, people were jumping out of third and fourth story windows. It was horrific. But some of the things that they learned was the theater doors opened into the theater. So to get out, the door had to open in, but everybody was trying to stampede out, so they were all pressed up against the door. And so, according to Jerome Powell, or this IMF person, their solution would be to lock everybody in their seats or to make the halls narrower so people couldn't get out as fast. That's the solution being floated by regulators right now, who are blaming the collapse of Silicon Valley Bank not on lousy bank management. They're blaming it on technology that lets people get their money out so fast. Well, if you've got a good bank, you don't need to worry about how fast people can get their money out. Now, the actual response to the Iroquois Theater fire was they invented the panic bar. It's, remember the big fire doors at your high school? You push on the bar and the door just flies open, right? Those big, it doesn't have door handles, it doesn't have knobs, you just push on the bar. It's called a panic bar. That was invented after the Iroquois Theater fire, so that if there's ever a stampede, the doors open easier, not harder. You let the people out quicker when you have something happening. Because, if there's a stampede in the theater, it's because the theater's on fire. You got to let people out. You don't lock people inside to solve the problem. And that's what's being floated by regulators right now. These banks are failing because they're insolvent. They're not failing because of short sellers. They're not failing because of PayPal or Venmo or technology or Zelle or the ability to access their funds. They're failing because the banks are insolvent, and the banks are insolvent because of what the Fed did. Because the Fed raised rates too fast and devalued the assets that those banks bought. And by the way, the reason why the banks bought all those assets at an all-time high was because those banks had such an influx of deposits in 2020 because of all this stimmy cash. So the Fed creates all this money, dumps it into the economy, people put it in the bank has to go out and buy assets at all-time high prices, all-time low interest rates. Then the response, because that causes inflation, go figure it wasn't transitory, the response is to raise interest rates and devalue those assets that the banks were all forced to go out and buy. This is a Fed-created crisis. And the solution that they're offering up is for the big banks to get bigger and to, honestly, the idea is being floated to slow down your access to your own money. My God, these people.
They're already like, I've been wondering to myself, why don't we have any banks that are 100% backed? They apply. There's banks like Custodia that have applied to get their banking license, and they don't want them. They won't let them exist. So you're locked in this intricate Ponzi scheme of banks in the United States, and there's no. I mean, there are other options, but in the banking sector, there are not, because they won't let them exist.
It's the regulators for you, folks. This is a regulatory created crisis. Absolutely. They'll blame everything. They'll blame Twitter. They'll blame YouTubers. I'm sure they'll blame me. I'm sure I'm going to get audited someday. Whatever. Thank you very much to Mike Bender from Robin RC. He says FTX bankruptcy lawyers seem to have a great case against GCC. Is that a digital currency group? Is that who you're talking about? Genesis? Digital Currency Group is the owner. Yep. They own Grayscale, GBTC, and underwrite Jump Capital and Paxos. It's interesting. A lot of names in there. As far as the FTX lawyers having a case, maybe the FTX lawyers have a case against some of the other crypto schemes that are out there. I'm not going to side with the FTX lawyers. But I can tell you, without knowing the specifics of this case, Mike, I haven't reviewed this particular development. I did see some whispers about this on Twitter today. If the Grayscale Bitcoin Trust is forced to liquidate, that will be a generational buying opportunity for Bitcoin, right? GBTC, they're one of the biggest owners of Bitcoin in the world. Actually, the biggest owner of Bitcoin in the world. Eventually, they're probably going to get liquidated. The SEC, look, Gary Gensler is a government stooge. All right. Any semblance of credibility that man had is gone because of his attacks on crypto. He's a stooge. Let's just put it that way. And if he can kill Bitcoin by forcing GBTC to be liquidated, that's what he's going to do. And I don't think he can kill Bitcoin. You can't kill Bitcoin. It's a network of computers that's very hard to trace. They'll try to kill all the things around Bitcoin, all the on ramps, all the off ramps. They'll try to discourage people with propaganda campaigns. They'll say it causes climate change. By the way, if you want to see some hilarious content, check out some of the videos that Bitcoiners have made about how the New York Times is causing deforestation and climate change because of all the paper they consume to print their media in the digital age. Talk about a backfire. That stuff's great. But all I can tell you is I am sitting on some cash right now, and if they kill the Grayscale Bitcoin Trust, if they force its liquidation, I will absolutely swoop in and buy up a whole bunch of it, because I don't believe in GBTC. I don't believe in Digital Currency Group. I don't believe in FTX. I do believe in Bitcoin. Bitcoin has no CEO. It has no company. It has no Sam Bankman-Fried. Bitcoin is just code, and we can all see it. So I believe in Bitcoin. That's my take on that one. Again, I haven't seen the specifics of that case. And, what you have is you have insolvent companies fighting over the scraps of themselves back and forth. So I'm not surprised to see them in court with each other. Thank you very much, Mike. I appreciate the super chat, sir. As always, you are a gentleman and a scholar as well. And let's move on because, all right, so we've got this. We talked about how, okay, we're going to start the rumor about possibly banning short sales. We are going to threaten short sellers with retaliation. And by the way, short sellers serve a vital market function, folks. There's predatory shorts who start false rumors about perfectly good companies and drive them into bankruptcy. That's not what is happening right now. We've got insolvent banks that the short sellers are exposing what is going on in banks. Short sellers naturally sniff out fraud in markets and bring it to light because there is financial gain to be had by sniffing out and exposing fraud. If you make it illegal to hunt out fraud and expose it to daylight, if you take away the financial benefits of that, then people are going to stop doing that. And who does that help? Well, that helps the fraud, doesn't it? If you ban short selling, then the people who are doing all this crooked stuff get away with it. So I am not in favor of banning short selling. I think short sellers get a bad rap. I don't like Ken Griffin and Citadel. I mean, what they're doing with the naked shorting. Naked shorting is a filthy business. Selling something that doesn't exist that should be a crime. Speaking of Gary Gensler and what a stooge he is, good job doing nothing about naked short selling, Gary. He's going after crypto. But lo and behold, take all those actions at the government, and the banks end up having a pretty good day, don't they? PacWest Bank up 80%. Not 80%. Still lower than they were yesterday, but they're up 80% today. Western Alliance up, 44%. They were up over 50% at one point. First Horizon Bank, they're not doing quite as well. They're up 7%. And then the Spider Regional Bank ETF, KRE, they're up 6.5% right now. All you got to do is start a rumor that the White House is going to ban short selling and threaten the short sellers with regulatory retaliation for trying to sniff out fraud in the marketplace. And all of a sudden the stocks go up. Isn't it funny how they did that? Imagine if they banned naked short selling. Imagine if they actually prosecuted the naked short sellers. I know I got some GME folks here.
Fire analogy, Jack. Short sellers they put their money where their mouth is, number one. And number two, they're the people that yell fire. Yes. And they're making it illegal to yell fire in a crowded theater, even if there is one. Yes. So back to that locked door analogy, you're not even allowed to warn people anymore because that's what short selling does. And they're not just yelling it; they're putting their money there, which means they believe it. It's disgusting if they pull that off.
Yeah, it's not. You don't gag everybody who goes into the theater because they might yell fire, right? Excuse me, I'm still fighting a sore throat. No, what you do is you prosecute people who yell fire in a theater that's not on fire. You prosecute wrongdoing. You don't make it illegal to yell fire in a theater that is actually on fire. I mean, think about it. If you see a theater that's on fire and you don't call it out, are you not partially responsible for the outcome? If you see that happening and you don't take some action to warn people?
Right.
The short selling serves a vital function in the market. It is part of organic price discovery when done within the confines of the law. If you want to sell something, if you want to short sell, you first have to borrow it and then you sell it. All right. You shouldn't be able to sell something that doesn't exist. That's naked shorting. That's what Ken Griffin and Citadel do. That is already illegal, but Gary Gensler, that stooge, does nothing about it. Naked short selling gold is already illegal. Ralston Benham and the CFTC do nothing about it. They see it happening. They make way for it. And we saw this during Silver Squeeze too, where the CFTC was actually threatening subtly, but they were threatening to take action against people in Reddit who were talking about investing in silver, right? They were talking about prosecuting the possibility of prosecuting people who were discussing trades with their own money openly in an online forum. They were talking about banning that. Meanwhile, you've got people selling stuff that doesn't exist for the sole purpose of suppressing prices artificially, and they never get prosecuted.
Yeah, I see this trend continuing. As it gets worse, it's the Bitcoin and gold people that are destroying the currency. You can see the narrative now. It's the short sellers that are destroying these banks, and when they come out with the CBDC, and it's inflating. The reason it is because these people on YouTube keep talking about gold and Bitcoin.
Yep. I like the shiny. Gold, silver, and Bitcoin. That's my... I don't buy gold, silver, and Bitcoin to get rich. I buy gold, silver, and Bitcoin to improve my worst case scenario. All right. I'm a nuke. Right. I do the fire thing like that. That's me. I see the catastrophe in every scenario. I look at a situation and I automatically see the worst thing that could possibly happen every time. That's just how my brain operates. And I immediately set out to mitigate that risk. And I look at the state of the financial system right now, and it took longer than we've been saying to happen, but everything the Perma Bears have been saying for years is now happening exactly how the Perma Bears said it would happen. And that's why you got to own physical precious metals. And, look, I'm going to catch some flack. I know the gold guys don't like Bitcoin. It's fine. If you don't like Bitcoin, don't buy it. But have a scenario where if this bank crisis keeps ending every 5 days, you know what I mean? Because this bank could end every 5 days in perpetuity, these bank failures. If this crisis keeps ending over and over and over again, make sure you're not going to be wiped out by that. And one of the best ways to do that is to own physical precious metals. It's not to say the price will go up or down. The price will fluctuate, but it improves your floor. It raises the floor for you.
Well, it should give you confidence. Like the people in charge, like Jerome Powell and these banking regulators, they didn't understand that the internet made withdrawals faster. Those are the people that are running this ship. And I'm thinking to myself, I think there's this call, like in the market, that they still have, there's this belief at least, that they still have it under control. And that these authority figures know what they're doing. And stuff like that, where they're like, we're just surprised that the internet exists and that people can withdraw their money this fast. That should give you pause.
Yeah. PayPal is not a new thing. Online banking is not a new thing. All right. And, back on the subject of gold, silver, and Bitcoin, if the deflationary crash does happen, if they decide they're not going to backstop all deposits and, the banks just start failing and the bank failures go the way Dodd-Frank intended, where the assets of that bank get put on fire sale and, people are allowed to bid in a free market environment for those assets, then asset prices are going to decline precipitously. Things like gold, silver, and Bitcoin will go down dramatically in that environment. All right. So I know that. But the reason to own gold, silver, and Bitcoin is, what if they decide to do the incredibly stupid thing of guaranteeing all deposits at all banks, all $17.2 trillion? Well, that guarantee becomes worth about as much as those dollars. Nothing. In which case, you better own some gold, silver, and Bitcoin. So, we still don't know which direction they're going to go. I mean, ultimately, we're still faced with the fork in the road, deflationary bust or hyperinflationary bust. But someone's going to take those losses one way or another. By the way, I want to say thank you very much to Gordon Nash, who says, GG is such a sweetheart. Ain't he? You forgot the S, buddy. Don't you be trying to out me in public like that. Gigi is a sweetheart, ain't she? Misgender Gigi. Oh, my God. Misgendering somebody. That's a crime punishable by lashings in the town square these days. Careful, Gordon Nash. But thank you very much for the kind words about Miss Gigi. She is a sweetheart. And thank you very much for the support of the channel, sir. I appreciate that. And thank you, Paul Bateman. Says, why don't banks invest in short-term yields instead of long-term yields so they're not locked in? Well, typically banks borrow short and lend long. That's historically always been how it's worked. And that model works. And it's historically worked very well because interest rates have been perpetually getting lower. And when interest rates go down, the face value of assets goes up. So, take a look at a chart of, say, the 10-year yield going back all throughout history. Give me 1 second. I'll bring up the 10-year yield here. Let's take a look at this chart of the 10-year yield going back to 1970, right? Now, as yields fall, bond prices go up, right? Give me a second. It's taking a while. Come on. My internet's going a little slow now. Let's put this. Here we go. All right, this is the 10-year yield going back to 1965, all right? So all the while here that these yields have been dropping, all those long bonds that the banks have bought have been going up in value. So forget the rate for a second. The face value of the bond has been going up as the Fed continually lowers time and time again with each successive crisis. So it's been very profitable to be a bank because as the rates go down, the face value goes up. So these assets that they buy with our money are going up in value on top of the interest that they're yielding. And the bank gets to keep the difference and pay it out to their shareholders in the form of dividends. The problem is when you zoom in over here and you look at this rate at which, at the rate at which they raised rates here. I mean, look at this. They've never raised that fast before. That is bringing down the value of all those bonds. Right? Let me delete my doodle. Trying to delete my doodle here. Sorry. Clear the drawing. The problem is all those bonds, they bought so many of those bonds with stimmy cash. And when was that stimmy cash issued? It was issued in 2020 and 2021. So look at the rate down here. So it doesn't matter if they had bought long or if they had bought short. This is when they had to buy all those bonds through the QE of the pandemic, and then when they maintained their monthly asset purchases all the way up until November of 2021. So the banks had all that stimmy cash. They were giving people money, either just outright checks in the mailbox or the child care tax credits. Everybody was getting direct deposits from Uncle Sam every month. That money going into the bank has to go offset that by buying some asset. And they bought bonds. And it doesn't matter what bond they bought. When the interest rates were that low, when you do this, when you raise rates like this, you create insolvent banks. You give them all of this cash. You force them to buy assets at historically overinflated prices. You make them buy at the top. Then you crash the prices and you wonder why they're insolvent. The Fed did this. There was no avoiding it. You can't raise rates like that without breaking something. And that's why people kept saying the Fed will raise rates until they break something. And Paul, the problem is the Fed didn't raise rates until they break something. The Fed raised rates until they broke something, and then they kept raising rates and things kept breaking, and they're still raising. They just raised 2 days ago. The second, third, and fourth largest bank failures in American history happens because of the Fed's rate hikes, and they still hiked again. These guys, there's hundreds, maybe even thousands of PhD economists working at the Federal Reserve and all their many member banks. You think they didn't know this was happening? You bet they knew this was happening. As a matter of fact, let's give me 1 second. Oh, I got to bring this up. I hope this comes up. I just had it. Give me 1 second. I'm going to dig this thing up because I went over this on my Patreon Zoom call on Wednesday. Guys, this is going to blow your mind. This presentation. It's going to take me a minute to find it.
So while you're doing that, even though you said they, no matter what duration they would have bought, they still would have been in, like, so my theory is they knew we're at the close to the zero bound with interest rates. So what were they? Obviously, they have to offset it by buying bonds. But that, with that understanding, I'm thinking, where else are they going to go but up? Even though they lied and they said that we're not even thinking about raising rates. If you're a bank and you realize we're at the zero bound when it comes to interest rates, were they just banking on the fact that if they bought a long-term bond, that interest rates would go negative, or what was their thought pattern instead of buying like 1 or 2 year treasuries. They bought 10-year treasuries.
Well, I could tell you Silicon definitely went out to the long end, the far long end. And Silicon Valley Bank, historically, the long end of the yield curve is the safest monetary asset you can buy, right? So any other time in history, if you look at what Silicon Valley Bank did, what they did was safe. It would have been viewed as incredibly conservative, very cautious. Now, they didn't hedge against rising rates. There are other instruments that you can go out and buy, swaps and things like that, where you can somewhat offset your risk of rising rates. Silicon Valley Bank did not hedge against rising rate risk. That was where they failed. And I think probably it was maybe a little bit of overconfidence on their part that the Fed wouldn't hike as fast as they did or as far as they did. The speed and the ferocity of the rate hikes is what did it. If it had taken longer for the Fed to hike rates, and then keep in mind they were fighting inflation while they were hiking rates, everybody was demanding that they do something, so they did something. Congratulations. That's really what did it. So, could they have bought 10-year? Could they have bought 2-year? Sure, and that would have mitigated somewhat the risk, but not entirely, because everything gets devalued. Everything was devalued with those rate hikes. Now, when I was saying, I forget what got me onto this as far as who could see this coming. This is a PowerPoint that was given to the Federal Reserve governors, including Jerome Powell, on February 14th of 2023. All right, 3 months ago, they gave this. All right, impact of rising rates on certain banks and supervisory approach. Jerome Powell was at this presentation. All right, bear with me. This was presented to these guys. Financial risks are growing for many banks, they said. Who could have seen this coming? Most banks are generally benefiting from rising interest rates. Net interest margins are expanding and credit quality performance continues to look favorable. So remember I said banks borrow short and lend long. So historically, rising interest rates, banks make more money because banks raise what they charge in interest. So that's why they're saying most banks were generally benefiting. However, rising interest rates are creating significant unrealized losses in investment securities and in some cases depressing tangible equity. Equity is banks' liabilities banks' assets minus liabilities. That's a bank's capital, basically the worth of the bank. So here you go, the second line of this presentation. Rising interest rates are creating significant unrealized losses in investment securities, and in some cases depressing tangible equity. Exactly the failure mechanism of Silicon Valley Bank. And this was 3 weeks before Silicon Valley Bank failed. This presentation was given to the Fed. As interest rates increase, banks with large market value losses could experience an increased financial and risk management challenge. You think? And where is it? Unrealized losses are highest at banks with long duration securities and or large securities portfolios. Banks reporting large unrealized losses may have limited ability to sell securities to fund loan demand or support any unanticipated withdrawals without recognizing losses. All right, now it doesn't let me highlight it, but that text right there. Banks reporting large unrealized losses, which is what started the collapse of Silicon Valley Bank. They reported a large loss on some of their U.S. Treasury securities that may impact their ability to fund loan demand or support unanticipated deposit withdrawals. That's exactly what happened at Silicon Valley Bank. But again, how could anybody have really seen this coming, right? I mean, they were only specifically warned about this exact type of failure, but it gets better. Slide 9 of this presentation, guys. Slide 9. They give a totally hypothetical, random example here of these risks. Silicon Valley Bank. That was the example in this presentation on February 14th, 3 weeks before Silicon Valley Bank failed. Jerome Powell and the other Fed governors sat in on this presentation where they said Silicon Valley Bank, the 18th largest U.S. banking organization, has significant interest rate risk. The bank used significant deposit growth to purchase longer maturity securities. Since year-end 2019, the investment portfolio as a percentage grew to 17 percentage points. Yield on purchases were low due to the rate environment and portfolio duration increased. At the third quarter end of 2022, total unrealized losses to capital totaled 110%. All right, so this right here, that line on this slide in this presentation, on February 14th, some guy, they don't know, they redacted his name. Some guy went to Jerome Powell and the other Fed governors and said rising interest rates is making banks potentially insolvent and they may not be able to meet a sudden surge of withdrawals. And they provided an example, Silicon Valley Bank, 3 weeks before Silicon Valley Bank failed. And in that presentation, they said at the third quarter end of 2022, so months ago, 6 months ago, 7, 8, 9 months ago, however long it's been, that bank was already insolvent. Total unrealized losses to capital totaled negative 110%. So as early as what, September of last year, Silicon Valley Bank had already lost more money in their investment securities than the total bank's capital. They were already insolvent months before the run. They were warned about it, and they still went on to hike. They still went on and raised rates even further. What was it, that early March rate hike? March 1st or February 28th, March 1st, FOMC, they hiked again. They warned Jerome Powell rising interest rates was killing banks. They specifically called out Silicon Valley Bank as the most vulnerable. He went and he hiked again anyway, and Silicon Valley Bank failed, 9 days later, 8 days later? But who could have seen this coming? Clearly, the problem here is that we have such easy access to our own money, right? That's the problem, Paul.
What a coincidence.
Yeah, amazing how that works. Amazing.
Do you put any, why do you think the big banks, JP Morgan, Wells Fargo, is it just that they have more deposits? So the risk, because they did the same thing to a certain extent. They had an influx of deposits, and now they have an influx of withdrawals.
So they have the same problem.
To fail, but
they are too big to fail, but they're taking the same hit, right? That their investment portfolio is falling in value just like everybody else's. They have the implicit guarantee of the Federal Reserve, of the FDIC. And the other thing is they have a bigger cushion. So if all things remain equal, if we just stay right where we are right now, the big banks will eventually fail anyway, right? So they're taking the hits too, right? But these hits don't kill JP Morgan. They don't hit Bank of America, who has more unrealized losses on their balance sheet due to treasuries than anybody. Bank of America has a huge amount of losses, of unrealized losses. But these blows don't kill them. They kill the little guys. So then the big guys can come in and gobble up what's left of the little guys, which kind of adds to their pain. But the big guys know sooner or later the Fed's going to pivot. Sooner or later the Fed's going to stop hiking, which they probably did just stop hiking. I think that was probably the last one. They're going to lower. The market is saying as soon as July they could lower. And when they start lowering, now all these assets that the big banks are buying up for pennies, their value is going to go right back up, because when you lower rates, you raise the face value of the bonds and the loans. So the big banks are being, first of all, they're getting free insurance from the FDIC. They're not paying anything extra for it, at least not yet. They're buying up all of these financial assets from these failing banks. They're getting free insurance on those assets. The First Republic deal, JP Morgan gets up to 80% of the losses of everything that they bought from First Republic covered by the FDIC if they go down in value, if they have to sell at a loss. Can you imagine? Can you imagine buying a stock where the government will give you back 80 cents on the dollar if you lose money? So just basically like free, no downside. The worst you could lose is 20%. My God. So when they lower rates, all the stuff JP Morgan just bought up is going to go right back up in value. And they're going to be even bigger. That's why the big banks are not complaining right now. They are taking their punches like everybody else is. The big banks are getting hit, but they can take it longer, and they know that they're going to come out of this even better. So, I mean, if we just stay here, like if we stay at this rate for 2 years, the big banks will fall too. Like that, they can't. I mean, and also keep in mind, these bank runs are being essentially forced on us by inflation, right? The average person is spending down their savings just to live right now. So that is an inflation-induced bank run. And I just want to say thank you very much, Dan Hedin, for your super chat. He says, sorry, came in late. So if you already talked about this, but with this jobs report, they might not pause the next meeting, not seeing the job losses they want. Everyone stay safe and stack the shinies. All right, Dan. So, honestly, I don't think this jobs report is going to have any bearing on what the Fed does next. I think by the time the FOMC gets together next time, things will be so bad. The question is going to be, will they lower or not? Not will they hike or not? I think they're done with the hikes. I think we'd be lucky to still be worrying about inflation a year from now. I think we're going to be if they just do nothing, we'll be talking about monumental deflation, and that's the big risk. That's why holding gold, silver, and Bitcoin. That's the downside risk with those, because if we get deflation, those assets are going to go down in value. But no, we didn't talk too much about the jobs report and the actions from the Fed. I think the Fed is done hiking right now. I mean, that last rate hike, the last two rate hikes will go down in history as monumental policy mistakes. They won't hike again from here. The question is whether they lower when they get together next, which is it June or July? Is the next FOMC? I'm not sure, but that's my take, Dan. They were crazy to hike yesterday or Wednesday. Will they keep hiking? I would be very surprised if we see it. Thanks again, Dan. Appreciate the super chat. And thank you, by the way, Dan, for your support on Patreon as well. Dan Hedin is one of our magnanimous melon heads over at Patreon. Link down below should you feel so inclined. And you're also going to see a link down below to Above My Pay Grades channel on YouTube. That's why you guys are here. You should also subscribe to Mr. Eric's channel. Eric has a good sense of humor over there, and he's got a very good mind for economic philosophy. Eric, you come up with some pretty good stuff sometimes. And I was cracking up at that San Francisco lady that you posted earlier today, by the way. That was so funny.
She's great, isn't she?
Oh, yeah. Nice lady. Nice lady. Go check out Above My Pay Grade and look at the short Eric did about this lady. What was that, like the San Francisco City Commissioner some meeting?
Mm-hmm.
Oh,
and
man.
she just screeches into the mic. So
Yeah.
don't turn the volume up too much.
Volume very low for that. Very low. Thank you very much. And definitely check out Above My Pay Grade. And thank you, Mike Kathman says CBDC. You know it's coming. Trying to get ready. Yeah, I do. And you know the thing we were talking about with locking people in the theater, and slowing down people's access to their money. That goes to show you what they'll do with the CBDC if they get it. So just another reason, right? It's the 2020s. It does not take very much imagination to imagine what they might be willing to do to us, right? They already placed us all under house arrest without charging us with any crimes or giving us the benefit of counsel or a jury of our peers. We were all placed under house arrest, and half of the country said thank you. They're very quiet these days. That other half, by the way, they're very quiet. They've moved on from that. Why can't everybody just move on? You were made a prisoner for years. Why can't you just move on? Well, go figure. People don't like being locked in their house. But yeah, CBDCs are coming. And what will they do with the CBDC? Look at that effeminate little fairy running things up in Canada, and look at what he did to people's money. People who parked their truck in Ottawa and said, we don't want to be forced to get an injection. Right? Regardless of your opinion on whether you should or should not, the question was whether people should be made prisoners if they don't. And the answer to that is a resounding no. People should not be made prisoners in their homes if they don't want to get something stuck in their veins. I'm probably going to get my channel in trouble here, but whatever. Sometimes I just can't keep my big yapper shut. That's why it's very important that you like this video and share it, everybody, because the algo, I tell you, growth in my channel ground to a halt. My channel was exploding after I did that FTX video back in November, the 60-second one. And then one day, shortly after the FTX video, I had a video get demonetized because I showed a Chinese police officer kicking a bank protester in the back. A plainclothes CCP police officer kicking a guy, and the only crime he had committed was he wanted to get his money out of the bank. And the bank wouldn't answer the phone. The bank wouldn't even unlock the doors. They just shut down. They told everybody they were shut down to upgrade their systems. And those people, to my knowledge, still have not got their money back. And, these people wanted their money back. And a bunch of plainclothes CCP operatives came in, beat him up, and they started dragging this guy away. And I showed a video while the guy was being dragged away. One of these police officers, one of these commie agents, kicks the guy in the back. And I was demonetized in that video for sensitive content. I think is what YouTube said it was, that I had posted sensitive content. They demonetized the video, and you can see it in my analytics. My views fell off a cliff off that day. And I was gaining between 100 and 150 subscribers a day on my channel to like 3, or losing 2. You lose subscribers all the time because there's bots that subscribe to your channel and say, click on my WhatsApp or Cash App me, all that other stuff. Watch out for those guys in the comments, by the way.
Yeah, same thing happened to me. They give you it's all arbitrary, but you're promoting violence if there's some kind of video documenting it. But to the question, I was thinking about CBDCs, and the one thing I can't get over is, as Thomas Sowell says, the first rule of economics is scarcity, and the first rule of politics is to forget about the first rule of economics. But the CBDC doesn't change that. And so when you were talking about 50% of Americans who are just kind of fine with that, I look to that as the bread and circuses, right? They are okay with government overreach as long as they have safety and prosperity. But the Faustian bargain of safety and prosperity can happen at the same time. And so that's what I think the government's running out of. This bread and circuses, we can print our way through prosperity, and the CBDC doesn't change that. The only thing it gives them is a more dystopian control mechanism, but it does not change the fact that your average American won't have bread and circuses anymore.
But it also gives them a very easy way to tamp down on dissent, doesn't it? If they can switch off your money if they don't like what you're saying. Correct. Which is exactly what Trudeau did up in Canada. Yep.
Yeah, I just think your average American hasn't woken up to what you talk about on this channel, what I talk about on my channel, because life isn't as painful yet as it needs to be for them to be like, oh, okay, no matter what I ask for from the government, they'll give it to me in dollars or CBDCs, but it won't buy me anything.
Yep. But give me that quote again. That was good. The thing about scarcity in politics.
Yeah, the first rule of economics is scarcity. First rule of politics is to forget about the first rule of economics.
And hey, we're talking about backstopping $17.2 trillion worth of deposits with the government's money, right? I think they waved bye-bye to scarcity a long time ago over at the FDIC, didn't they? Wow. Thank you, AK, for your super chat, sir. He says, this is not like 2008. Things were not sound then. 2023, things are sound. Very sound. Yeah, very sound. We're all sounded out here. No more sound, please. Please, turn down the sound. I am so short. I am short the NASDAQ. I've been short the NASDAQ for the better part of the year, which has been a losing proposition, I might add, because they just keep reinflating, all right? I mean, if they had followed the law, those NASDAQ shorts would have been money printers for me, because we would have had a deflationary collapse by now, because they were not supposed to bail out Silicon Valley Bank. And Silicon Valley Bank was the bank where all of the tech companies kept their cash, and I was short tech, and I was like, wow, these NASDAQ puts they're gonna print, man. Nope. No, because they just reinflated. And so far, the implicit guarantee of all deposits at these banks, so far they have chosen the route of inflating it. It's amazing, because we're just coming off the worst inflation since the 1970s, which in a lot of regards, it was actually worse than the 1970s. And they're still choosing the route of inflation. And the speed with which they arrived at that decision, it's amazing. I mean, we're only a few months removed from 9% inflation prints, and you see how quickly the Fed loaned trillions into existence with their new programs and the Federal Home Loan Banks. Amazing. I don't know if trillions, hundreds of billions they loaned into existence. It may be a trillion. The borrowing at the Federal Home Loan Bank spiked by $200 billion last month. Bank Term Funding Program, the discount window, the currency swaps with the European banks. You're probably pushing $1 trillion if you get into that. And again, this is the early crisis, folks. The real crisis has not even started. And, we've been running an hour, so we're not even going to get to the articles I had queued up about commercial real estate or not today. But thank you very much, AK. I agree with you. I am short. I'm not so short. I have some small trades in place, but I'm just sitting the sidelines right now because they're changing the rules as they go, and it's really hard to navigate this landscape. So, I'm focused on improving my worst case scenario. I'm not being too aggressive yet with my trades, because it's just, you go all in on a short, you could be right, and then they change the rules and they wipe you out. So it's really hard to win in that scenario. You know, play Monopoly with a kid who's just dipping in and grabbing a pile of 500s every time things get tough, and go figure, you're not going to beat that person. So, all right, guys, I think we are all caught up here, and let me make sure I got at least most of these done. Yeah, we got through about as many of these as we're going to get through. So the markets are closed right now. We are done for the week. We got the S&P closed at 4136, up 75 points. The Dow ended up closing up 546, 1.65% for the Dow. And the NASDAQ, not so good for Jack's NASDAQ puts. The NASDAQ up 269 points, 2.25%. Sure, banks are failing. Commercial real estate is imploding. People are living in tents. Buy Peloton stock. Sure, why not? Yeah, it's a $5,000 exercise bike with a TV duct tape to it. Sure, buy Peloton stock. Just do whatever Kathy Wood says. She's very groundbreaking, very innovative, Kathy Wood. Rule number one of economics is scarcity, and the rule number one of politics is forget about rule number one of economics. I got to remember that quote, Eric. That was awesome.
Yeah, that's Thomas Sowell.
Thomas Sowell?
Yeah.
Very good. Very good. You got anything you want to add, brother? Give us something for the weekend. What's going on? What's going on over there?
Yeah, me and Jack might get together in person maybe tomorrow. But yeah, I'm just hanging out here in Atlantic City, first time here. And if you've never been, it's depressing. It looks like a Call of Duty level. It's like abandoned, just, yeah, it's really sad. But yeah, the thing I'm thinking about into the future just is the mortgage interest rates, like how everyone's hurting to buy a home, but like people, we had talked about this before we hit record, like the long-term problem of mortgage rates, which are bonds, essentially when they're securitized, who's going to want to buy one that yields 2.5% in a inflationary environment? And 40% of mortgages were issued or refinanced in that historically low interest rate environment. And people don't want to sell those. People do not want to sell those because the asset in that case is your mortgage, not the house, and to a certain extent. But yeah, that's what I'm watching and just working out here, and hopefully we can get together in person.
Yeah, I'd love to do that. And a little bit of advice: if you're in Atlantic City, do not go more than a block off the beach. All right, stay on the strip, brother. Don't wander Atlantic City.
I've seen a hypodermic needle once or twice just in my short visit. So
I've had some good times in Atlantic City. I mean, it's a nice town. I grew up not too far from Atlantic City, so I know the area, and I know not to wander. Let's just put it that way. All right, brother. Thank you very much, Eric. Folks, check out Above My Pay Grade. I got a link down below to Eric's channel. It's one of those undiscovered gems of the financial YouTubes, and we hope to make it undiscovered. No, we hope to make it discovered with this appearance today. So we'll have to have you back on the channel sometime, and hopefully we can get together this weekend. Also want to say thank you to all of my Patreon supporters for everything you do. Thank you to my moderator, Mish, who was not here with us today because Mish is on the road, but he is with us in spirit. Thank you to my Blue Wrenches for keeping things clean and tidy in the chat. And hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.